All right, can everyone hear me? Okay, I'll assume that's a yes. So today, I would like to give my gratitude to the Diaspora Success Network, to Victor, to Adiola for this opportunity. I am very passionate about this topic, so I'm super excited to be doing this today. I'm not sure I'm hearing, the local location, but I will continue with the presentation. All right, so today we'll be talking about proactive tax planning. And the goal here is for everyone to stop overpaying and to start planning. Again, the goal is for us to understand strategies that we can use to stop overpaying and start planning. A little bit of intro. My name is Olu Oyewale. I am a certified public accountant, licensed in the state of Texas, and I'm also a certified management accountant. I actually started off my career at Deloitte & Touche, which is a Big Four accounting firm. And then most recently, I served as an IRS agent with the Internal Revenue Service. And during my time at the IRS, I was auditing taxpayers. And this was the reason why I decided to actually start my own firm. During that time, being on the other side, auditing people, I realized how frustrating it is, or how frustrating it can be without tax planning. When the IRS is actually auditing you, there's no limit to what they can see. So they can see everything. They can request for evidence from third party. And really, it's an experience that could be a good one if you plan and do things the right way. And it's also an experience that could be very frustrating if you don't do things the right way. So during that time, I decided that I was going to create my own firm, which would be focused on tax planning. Again, proactive tax planning, because anybody can file taxes. Basically, a lot of, we have tools like TurboTax and a lot of people that are tax preparers. You don't have to be a CPA. You can even file your taxes by yourself. So anyone can file taxes, but the most important part of that is planning. Again, planning and making sure you're compliant and you're doing everything the right way as it should be done. All right, so today we're going to have some fun. I'm already excited. There are 4 things that we'll cover today. So the first one is why tax planning matters. Basically, why are we here this afternoon talking about tax planning? The second thing is to know your own return. So this is going to be more practical, more hands-on. We're going to go through a Form 1040. We're going to discuss some of those important components. And then after that, we're going to discuss some compliance requirements. Basically, what are the rules and obligations and requirements that the IRS is expecting of you as a taxpayer or as a US citizen or as a US resident in this country? And then finally, we're going to go over some strategies, but I'd like to give a disclaimer. Again, this is for educational purposes. None of this are specific to any individual. It's better for you to actually sit one-on-one with a CPA to get an individualized plan, because everybody has different financial stories and tax profiles. But this would be more of a general, strategy based on a category that you fall under. If you're a W-2 earner, if you have a business, if you have an S-corp election, if you're a real estate investor, we'll cover all of those general strategies. All right. So why tax planning matters? So first of all, one thing that a lot of people need to understand is that taxes are actually an expense. And the moment we start to understand that, the better we start to realize how much of taxes are being taken from our purses, right? So for some people, taxes are actually the single biggest expense. When you think about the federal taxes, the state taxes for states that actually collect income, state income taxes, when you think about payroll tax, you think about self-employment tax, and then we even go into property taxes and all of those. Taxes are pretty much, for some people, the single biggest expense. And we actually think of other expenses. We try to negotiate, down the expenses. We're trying to reduce expenses. But a lot of people don't put that much effort into their taxes. They just sort of feel like, it's a requirement for the government to take this much from me, and I don't have to worry about that. But it's very important for us to look at it as an expense and basically start to plan towards reducing that expense. Again, this is an expense we know we have to pay every year. So why don't we take the time to plan and have a strategy to reduce it every year? So this is one of the reasons why tax planning is very, very important. The next reason is that the tax code actually rewards actions a lot of times taken before December 31st, which is why I'm super excited we're doing this now, which is the second half of the year, so that people can start to implement some of these strategies early on. So I've seen in the industry, a lot of people, they wait till March of the following year and they go to their tax preparer and they basically say, get me the most money possible, or I want the biggest refund, or I want the biggest money back. But what they don't realize is they ignored the time they were meant to be taking action, which is from January 1st to January 31st. And then now they want magic. And the problem with magic is that most times or sometimes, the results are not always great, right? So we have times where preparers are forced to sort of just come up with things and come up with creative accounting and just cook up some things that do not exist. And trust me, from my experience, right now I'm currently representing some clients. They're going through audits, and the juice sometimes is not worth the squeeze, right? When the tax preparer is coming up with these shady loopholes or things, sometimes it's not worth it, because you can get that $5,000, $10,000 refund now, but you have to pay for it after like 2 years when the IRS comes knocking. So again, the tax code typically rewards actions taken before December 31st. So this is perfect that we're having this session today, so that hopefully at least one person can take something out of it and start to implement it before December 31st. All right, the next one is that if you are not planning, you are overpaying. Again, if you are not planning, you are overpaying. So we hear it every time that the most wealthiest people don't necessarily have the highest effective tax rate, because these people, they have CPAs, they have accountants, they have attorneys that work with them to plan, okay? So they're not having a lower effective tax rate because they're just waiting till tax filing season. No, it's because they're planning. So I promise you that if you plan, you would find ways and opportunities that you can optimize and reduce your tax burden, still being compliant. Again, still being compliant. And then finally is the fact that we're so used to filing, which is absolutely important. It's a requirement. But we need to understand that filing is looking back, whereas planning is looking forward. So planning is looking forward. Again, when you plan, you're thinking, okay, in 2026, this is my plan. And then you're also thinking for future years as well, okay? There's some tax strategies that you can utilize whereby you're thinking of the future years and you decide of what is best to do this year versus next year versus the following year, okay? So planning is looking forward versus filing that is just looking back. So again, these are the reasons why tax planning absolutely matters, and we should definitely take it more seriously. All right, are there any questions as of now? Okay, so I'll proceed. So the next section is making sure that we understand our return. So return is basically, the Form 1040 for the federal income taxes, and also all the schedules attached to it, all the forms attached to it, and then also your state income tax return as well for states that require state income tax. But today we're going to focus more on the federal tax return and basically making sure that we're able to read and understand very important metrics to be able to plan. You cannot just plan without realizing your current tax profile. You have to understand, where am I today? And then based off that information, you can decide to plan for the following year and the years to come. So today we're going to do a look back on 2025 to see what is your current tax profile. Once we have that information, we can begin to think of how the strategies can help us have better metrics. So first of all, I'm just going to show Form 1040. So this is just the basic Form 1040, the 2025 version. And just want everyone to sort of look at this and try to understand it. Again, I have situations where some people just send off their documents to the tax preparers. They don't really understand the forms. They don't know what is there. So hopefully we can shed a little bit of light on the 1040 today. So again, I cropped out the information, basically just personal information of the taxpayer, or if it's married filing jointly, the spouse as well. But starting from the income section. So here the IRS wants to know all your income. Again, the goal of this is total income. So the line 1A starts with the income on the form W-2, which is a salary, typically your salary, an employee compensation. So we start with that. However, to know the total income, we have to consider other sources of income, okay? So household employee wages, if that is the case. For example, if a family member is serving as a nanny and is being paid, and that is expected to be, any form of income is expected to be reflected to the Internal Revenue Service on this form. If you go down the line, you can see interest, right? So you invest and you get interest, you need to report it, except as a tax-exempt interest. So you need to report it. We can see dividends, you need to report it. We can see IRA distributions, we can see all of that. And the goal here is to have the total income. We can also see the income from the Schedule 1, okay? So we have income from the Schedule 1, which Schedule 1 goes further into Schedule C, which is for small bit, like for a business, goes further into Schedule E, which is from real estate rental property, which goes further into Schedule F, which is farm income. So for people that have a farming business and they have income, they report it on the Schedule F. So again, the goal of this is to get to the adjusted gross income, which is basically the total income and adjusting for adjustments that is provided for Schedule 1. Okay? So does everybody understand that? This is an expectation that all the income, all the taxable income is reported. And then after that, we can get the number, which is the adjusted gross income. So after we attain that number, the adjusted gross income, then we begin to subtract the deductions. So we have an above the line deduction and we have a below the line deduction. At this point, we're looking at the below the line deduction. So we have the standard deduction or the itemized deduction. Now, the difference is that the standard deduction is a number that is provided. So for single or married, there's a specific, for single, there's a specific number. For married filing jointly, there's a specific amount. For married filing separately, for head of household, there's specific amounts. Now, the only way that you can utilize an itemized deduction is if you're able to show that your itemized deduction actually exceeds the standard deduction, okay? So you should be able to look at your tax return, your Form 1040, and see what is there. What is the deduction that I took in 2025? Did I take a standard deduction or an itemized? And even if it was a preparer that did your tax return, you need to be able to know what was done. Again, let me go back to my story at the IRS. Anytime anybody is picked up for an audit, they are responsible for their tax return. They can hire a CPA like myself or an attorney to represent them. However, they are still responsible for the tax return. They cannot say, my tax preparer prepared it, and they put that you are responsible for your tax return. Think of a tax return as a financial report that you provide to the government. Your name is on it, your social security is on it, it's your report. So for people that are used to just sending their files to tax preparer and they say, oh, it's filed, and they don't take a look at it, they don't understand, they don't review, this is a reminder to you that you are responsible for your tax return. All right, so after taking the deductions, we can see that that brings us down to the taxable income. Now, the taxable income is now what a marginal tax rate is applied on in order to actually attain the total tax. So marginal tax rate, which I'll go further into, basically starts from the first, it basically builds up, right? So for the first 10,000, there's a 10%. For the next this many thousands, there's a percentage, right? So that is how the tax is being computed. So it's something that we can also do ourselves. We could grab a calculator, we could pick our taxable income, we could pull up the marginal tax rate and begin to compute it ourselves. Again, you're responsible for this and you're responsible for your tax return. All right. So after that, the tax is derived. However, there are credits available. So there are refundable credits and there are non-refundable credits. So those are applied. And after those are applied, then we're able to actually come to the total tax number. When we get to the total tax, we then basically compare what has already been withheld to be able to understand if you're actually getting a refund or if you're going to be paying back. Again, it's a comparison game. You get the total tax number, then we realize what has already been taken out from your W-2 or estimated payments that businesses are expected to do, and what is meant to be paid back, what is meant to be paid to the IRS, or what is meant to be taken as a refund. Are there any questions? Okay. All right. So just again, these are metrics that I want us to go over that are very important and is something that we should pay, attention to and sort of understand. So the first one is the effective tax rate. So again, I would like for everyone, if you have your Form 1040 with you, to compute this number.
Can you hear us?
Now I can hear you.
Okay. Someone has a question. Sir, you can go ahead.
Okay, the standard deduction.
Can you hear him?
Yes.
Okay.
The standard deduction and then the itemized deduction. If your itemized deduction is higher than the standard deduction, how do you treat it?
So if I got the question, sorry, go ahead.
He said if your standard deduction is higher than your itemized deduction, how do you fix it, right?
How do you treat it?
How do you treat it?
Okay. So if the standard is greater than the itemized, then you just take the standard. So that's it. You just take the standard. However, that's an opportunity for you to think and plan for the next year and say, okay, now I want to increase my itemized deduction. I want to understand all the potential deductions that qualify for itemization and leverage on those. Some examples of those, if you own a property, will be the mortgage interest that you paid on the property. So if you have your personal residence, the mortgage interest on your property, the taxes, the property taxes, the state taxes, and then charitable contributions. So if you donate to a 501c3 organization in the United States of America, all of those are classified as itemizable. So if your standard is more than your itemized, you have to take the standard. But that's why we're doing this right now. So we can look at 2025 and say, did we only get the standard last year? If that's the case, this year we need to try to itemize. But again, itemizing only makes sense if it's more. So again, some people it might not work for, but some people it might work for. Okay. Did I answer your question, sir?
Yeah, thank you.
Okay. All right. Are there any other questions?
No.
Okay. All right. So the effective tax rate, like I mentioned earlier, is very important. It's a number that we should know. So if I ask all of us in the room, what was your effective tax rate in 2025? Can anybody answer? I mean, I'm not like, just curious. Does anybody know it offhand of what the effective tax rate was? And that's fine if you don't know it, because that's the purpose of this session today. So the reason why this is important is because this allows us to understand the percentage of our adjusted gross income that we actually paid to the government in taxes. So this is the percentage. So if it's 20%, 10%, 15%, that's basically saying of my adjusted gross income, I paid 10% to the government. I paid 20% to the government. It's a number we were meant to know because the goal is to be able to reduce that number. Again, the goal is to be able to reduce that number. So just as an example, a married filing jointly, basically a couple that has an adjusted gross income of $150,000, even though they sit in the 22% marginal bracket, which I'm going to speak about, if they paid $21,500, basically it's just the $21,500 divided by 150,000, and for that couple, they're around 14.3%. So once you know that number, you can then plan and say, okay, for 2026, I want to get that number to 12%. So how am I going to do this? I have to incorporate strategies and make sure that I'm staying compliant. So the effective tax rate. So I would encourage everyone to find some time to compute this number and know the number and basically plan towards making it lower. All right, so the next number is above the line adjustments. So again, when I walked through the 1040, we saw the way we computed the adjusted gross income, and then we have an adjustment right before that. So this is something you just meant to understand. Do I have any above the line adjustments? This might be something that is more so for business owners, but that's something to just know. Do I have any above the line adjustments? So again, you can find that on the form 1040. The next, which we just covered, is the below the line deductions. Again, we spoke about standard or itemized. So this is also something this is a number that we should know. We should know if we're itemizing or if we're not itemizing. And we should know, why we're doing either or. Again, you are responsible for your tax returns and the report. The next is the taxable income ratio. So basically, this is just computing your taxable income divided by your adjusted gross income. So of the total adjusted gross income, how much of that is considered taxable? So how much of that is considered taxable? That is the purpose of this computation. And again, you would understand that whatever is not taxable are the deductions, right? So the deductions that you already took, we remove that from the adjusted gross income to come to the taxable income. But it's good to realize, am I 75% of my income taxable? If that's the case, why don't we try to get that to 60% while being compliant, while utilizing strategies? So this is a percentage that you want to know. So I advise everyone to compute this based on 2025. What percentage of my income was taxable? And and then we can plan and try to reduce that exposure for the future and for the current year as well. And then the tax credits, right? So all the tax credits that are available, we have refundable, non-refundable. Basically, you need to know which ones you're claiming and why, and if you're actually eligible, right? I do have a client right now that I'm representing that took some credits. Again, the clients mentioned that it was the tax preparer that took these credits. The client is not eligible for those credits. However, the IRS saw that the client claimed these credits, and now, she had to hire me to represent her, right? So again, just an encouragement. Let's try to pay more attention to this and take it more seriously and just make sure we're doing the right thing. Because at the end of the day, you're going to, if anyone is audited, you might still have to spend or, whatever you're trying to save right now, you might actually have to spend it back. So please, let's make sure that we understand the tax credits and whatever we're claiming, we're actually eligible for it. So total federal tax withheld. So again, this is a number that we should know. I know a lot of people care about the refund, which is great. However, we should know what has already been taken from our paycheck, and we should understand if we're paying back, why are we paying back? Or if we're getting a refund, why am I getting a refund? These are very important, and we should pay more attention to this as well. This also helps because in a situation where, as an employee, your W-4 it needs to be adjusted, this is a way to look back and say, oh, enough was not withheld from my paycheck. I need to go adjust my W-4. So this is a number that we should also pay attention to. Again, on your 1040 from 2025, I advise you to go take a look, identify this number, and then you can basically make the judgment if it's fair or if you need to go adjust your W-4. And then finally, one of the other important ones is the federal tax payments, right? So total federal tax payments. So again, you want to know what you're paying. You want to know the amount that you're paying. I think it's also a way to think about, the way I think about it is, income taxes are one of the major revenue sources, right, for the US government. So if I'm paying $50,000, I want to know, because to me, it's something I am proud of. I'm supporting the country, but again, it's a number that you should know. How much are you paying as federal income taxes to the US government? And then this is marginal federal tax rate. Again, I mentioned that basically once we attain the taxable income, it's a marginal tax rate that is used to compute, right? So the first couple of thousands is based on the lowest percentage, and then it continues to build up. So even if some people say, oh, I'm in the 35% tax bracket, most times they mean that the highest amount of their income is being taxed at 35%. Doesn't necessarily mean that the effective tax rate is 35%. The effective tax rate is different, okay? So marginal tax rate is the way the taxes are being computed. It's different from what your effective tax rate is. I personally think the effective tax rate is more important for me because I want to know what portion of my total income is taken as taxes, okay? But this is the way the IRS computes it, which everyone can do for themselves. They can take a calculator and basically begin to compute from their taxable income to their taxes. And I know this doesn't apply to everybody because there's some states, I live in Texas and there's no state income tax, which we love. But for states that do have state income tax, you also need to understand your state income tax burden as well. Again, you need to understand your state income tax burden, and you need to basically understand what the state provides. A lot of times the state provides some additional credits and deduction opportunities that is different from what federal provides. So that's also something you want to pay attention to as well. And then finally, just figuring out what am I paying in total, right? Federal, state, I need to know what that is. This number sort of puts all of that together of federal, state, and basically knowing what percentage that is of your income. So I'm gonna pause here because I know we've gone through a lot, but these are metrics that would be valuable for you to, at least, even if it's a one-time thing, just do it and understand, what you're paying. Understand the percentage of your income that is going to the government, that is going to the federal government, that is going to the state government. And once you've done that, you can now begin to plan and say, okay, I did standard deduction last year, but I was actually close to itemizing. Why don't I do some more charitable contributions this year? Why don't I do this? Why don't I do that? You can only do that after you understand your current tax profile. So that's the purpose of this exercise, is to really understand, where do I stand right now? And then after that, we can now begin to implement strategies to make it better. So are there any questions?
Yeah, I have two questions. Number one, on this form, does it show where your state tax and total taxes are? And then the second question is, can you show the formula for the taxable income ratio again?
Yes. So because, different states have different, returns, and everything is structured differently. So the guidance is to go to your state return and actually find it, but it will be there. Like once you just look through. But again, we have different states with different, forms. We have some states that don't even have, state income tax. But again, the guidance would be to go to your state return and basically, find it. And you ask for the taxable income, the taxable income ratio. So basically, it's just taking your total taxable income divided by your adjusted gross income times 100. Again, this computation is trying to understand your exposure. How much of my income, my gross income, is taxable? How much of my gross income is taxable?
Thank you.
Sure. Any other question? All right. And again, we talked about the adjusted gross income a lot, but it's also it's important again for this reason, because there are sort of limits and thresholds that reflect back to your adjusted gross income. So, for example, there's some deductions and some, extra deductions that you can get if your adjusted gross income is within a particular range. So, long story short, know what your adjusted gross income is, because it determines some other things that you can potentially qualify for. All right, so the next section is one that I'll beg you to please pay attention to. Really, if this is the only thing you can get from this training, I will be so excited. So there are compliance requirements that the Internal Revenue Service expects from taxpayers. Some requirements are expected of US citizens, US residents. And the first one that I will talk about is one that is very near and dear to my heart, because when I was working at the IRS, I actually did a case study on this and I presented to our leadership. So this is the F-bar. So F-bar is basically foreign bank accounts report. And what the F-bar requires is that if at any point in time you have $10,000 or more in a foreign bank account, you are meant to report it by filling the form 114. Again, if at any point in time, not at the end of the year, if at any point in time you have more than $10,000 in a foreign bank account, you are meant to report it. This is a requirement for US residents and US citizens. During the case study, I realized a lot of people do not know about this. And again, there are penalties attached to this. There's non-willful penalties and there's willful penalties. So for my people that have money in other countries, in Nigeria, in Ghana, in the UK, if at any point in time you have more than $10,000, there is a requirement. And the form is very fast, like it's probably 5 minutes to fill the form. But a lot of people don't know about it, or they don't think they'll ever get caught. But what I'm going to tell you today is that if they do pick you up for an audit, or for some reason the IRS looks at your situation and they do find out that you have foreign bank accounts that you're not reporting that has more than $10,000, it could actually become a big situation. So please, please, please. The deadline is April 15, but it automatically extends to October 15. So if you have not done that this year, you have time to do that. Again, more than $10,000 in a foreign bank account, you need to declare that by filling the FinCEN form 114. Okay, I think I've said a lot on that one. But please, please, please make sure to report that. And then with your tax return, there's also the FATCA form 8938, that if you do have financial assets and interest, you're also meant to complete that form. So please, let's be very compliant and just do what is expected of us. And also just general compliance requirements as taxpayers. Again, number one is report all taxable income. I've met some people that, they do business transactions all around. They have money coming in from Zelle. They have money coming in from Stripe. They have money coming in from everywhere. And sometimes they choose and pick which one to report. Again, according to the Internal Revenue Code 61, the expectation is to report all taxable income. Also, file the tax returns accurately. So I feel like I've spoken a lot about that, but we need to be accurate in filing our tax returns. The next one is the deadlines. So we know the deadlines, we know the extension opportunities, we need to take advantage of those. I know people that are, I've spoken to some people that they haven't filed for years. Again, let's try to do what is right and just stay compliant. And then maintaining adequate records and documentation. So this one is very, very important. Again, like I mentioned, I was auditing taxpayers, and I would say the biggest thing I noticed is lack of adequate records and documentation. The Internal Revenue Service they want you to substantiate. So anything that you're claiming, any deduction, you need to be able to explain or provide evidence of what you're taking, right? But if you're not providing the adequate records and documentation, we have no other choice but to conclude that it's not deductible. Okay, so it's in your best interest to maintain adequate records and documentation. This is very important. For small businesses, you want to make sure that you have an accounting platform, maybe QuickBooks or anyone that you prefer to use. Or even if you're using Excel, just make sure that you're recording things the right way. If you're taking deductions on certain things, you're making purchases, have all your records, have all your documentation. That is very, very important. I tell my clients, don't be scared of an audit. If you're doing things the right way, you shouldn't be scared of an audit. Because what is an audit? An audit is basically extra scrutiny into your tax returns or your tax report, like we mentioned. It's a financial report. So if you're doing things the right way, why are you scared? So again, let's try to do things the right way, maintain adequate records and documentation. Also, along with that is being able to substantiate your business expenses and your deductions. The IRS really wants substantiation. So for example, travel expense, that's a big one. If you're traveling, if you have a business and you're traveling for your business, it needs to be very clear that this was for business. Sometimes we have people commingling personal travels and representing that as business. So that is something that we need to be very careful about. You can still potentially do personal activities. However, the travel has to be for business purposes, and it has to be clear that you're doing business during that travel. So substantiation is very, very important. And then, like I mentioned earlier, maintaining separate business and personal records. For small businesses, let's try to avoid commingling. So some people have their personal accounts, business accounts, and everything is just moving all around the place. Yeah, let's try to keep our business records, business bank accounts, use that for business, personal, use that for personal. Again, these are requirements that have been stated in the Internal Revenue Code. Is left for us to follow these requirements. And if ever somebody's been audited, they will go to these and say, these have been provided. You're meant to follow all these codes. All right, so again, like we already mentioned, properly classify, business income, business entities, properly calculate depreciation and asset basis. All right, so now we're going to transition into strategies. Again, I intentionally put the compliance before the strategies. So we know that, okay, even if we want to use these strategies, we need to make sure that we're complying with the required regulations and expectations. All right, so not all income creates the same tax planning opportunities. So we already know W-2 employees, at the end of after the year, you're issued your W-2. As you're being issued your W-2, the W-2 is being sent to the Internal Revenue Service. So they have a copy of it, right? So we know that with a W-2, your taxes have already been withheld. So with that, there are strategies and there are opportunities, but it's not as compared to the next layer, which involves a business. Okay, so again, we're going to walk through all of these one by one. But again, as a W-2, you have some opportunities, but it's quite limited. Once you begin to have a business and then real estate investment, and then, that's where the real opportunities, really like extra opportunities, come in at that point. All right. So for W-2 employees, what I typically advise my clients is we need to try to maximize the pre-tax vehicles first before trying to look for some other strategies, okay? So I encourage my clients to max out their traditional 401k contributions if they can. So for the year 2026, it's $24,500 per person. So I advise my clients to max that out as much as possible. Again, some people confuse the employer match with the contribution limits. Your employer can match whatever they want to match. I personally don't pay attention to what they're matching. It's good to know, but I focus on what I am contributing. Again, as much as it's possible for you, because I know people have different financial situations, try to max out your 401k contribution if possible. Then also, like I mentioned, the employer match is good. So that's also something to just know about. We have the HSA, which is the health savings account, that you can also max out if you're able to. What the HSA does is that it gives a triple tax benefit. So the first one is that, it reduces your taxable income right now. And then it also, you can invest it, it can grow tax-free. And then when you use it for medical expenses, you don't have to pay taxes on it as well at that point. So HSA is good in terms of reducing your taxable income now. You could invest it, it could grow. And when you use it later for medical expenses, you don't have to worry about taxes as well. And then the backdoor Roth IRA. So this is for the people that make a lot of money and they're unable to qualify for the Roth IRA. So I have a couple of clients that have to do the backdoor Roth IRA to be able to, add more money into their retirement accounts. So basically, this is just like a way to sort of, even though we don't qualify, this is a way to go around that requirement. So what happens in this situation is they're able to put the same money, $7,500, into a traditional IRA, and then they turn around. So it's a non-deductible traditional IRA. They turn around and move that money into a Roth IRA. Again, this is for people that make like a lot more, I believe above 165,000, that are not able to qualify for the Roth IRA. They can do the backdoor IRA. However, it's important to speak to a CPA during your tax filing to make sure that you're doing the right things, because this is one that the IRS looks at a lot of making sure you're actually doing the conversion the right way. Going forward, tax loss investing. So again, this is an opportunity where potentially as a W-2 employer, you're also looking into the capital markets or you're doing some other investments. And unfortunately, you don't make profit, you don't make a gain, you make a loss. You can also apply this loss, for example, for capital market investing up to $3,000 each year, and you can carry over the loss. So this is a way to also reduce your taxable income. But again, I know we all don't go into investments with the plan of losing, but in the event that you have a loss, you can also use that to reduce. And then the next one is optimizing itemized deduction. So I know we spoke a lot about standard versus itemized. So there are different strategies that you can use to optimize for itemized. One big one is charitable contributions. So I advise my clients to look for organizations, 501c3 organizations, such as Goodwill, Salvation Army, Habitat for Humanity, and make sure to donate, okay? So anytime I have something that I haven't used in a couple of years, it's going to Goodwill. And when you go to Goodwill, they give you a receipt showing that you actually donated. And you just have to be reasonable in putting the fair value of what you donated, okay? So again, you have to be reasonable. So, I donated, for example, I donate a couch. They give me a receipt. I am expected to put the fair value of the receipt, of the value on the receipt. So that's a way that people can potentially increase the itemized deduction. Another way is a donor advised fund. So this is one that I've started to do myself. But basically, a donor advised fund allows you to create a fund that you can fund now, and it can count towards your charitable contribution now. It can count towards your itemized deduction now, but you use it later. So for example, I have some extra money, but I don't quite have an organization that I want to support right now. I can put the money in a donor advised fund this year, and it would be deductible for 2026. But in 2027, I could contribute to a 501c3 of a friend or a 501c3 that needs money. So again, it's something you can do now. You could put the money in a donor advised fund. The only restriction to that is whenever you do use the money, it must be to a 501c3 organization. So you cannot use it for personal things later on. But that's another way that people sort of increase their itemized deduction. And then the last one is employee benefits optimization. This is just a way that you can potentially negotiate with your employer and be like, oh, are there ways that you could provide other benefits to me, and basically not necessarily put it like reduce my income, but those go to the benefits, right? But for W-2, there's a little bit of restriction, but even with that, there are ways that you can use these strategies. And this is just assuming a W-2 earner that does not have a business, does not have real estate, this is just a simple W-2 earner. Are there any questions before we move on?
Yes.
Okay.
The donor advised fund, is there a limit on how much that can be? And can you fund your own 501c3?
That's a good question. So for the donor advice fund, I believe there's different organizations that run it. So I typically refer my clients to Fidelity. I believe there might be a limit of 25,000. I'm not 100% sure, but that's probably something to check. But I know Fidelity is one that I typically refer people to. So that's for the donor advice fund. And then to your question of funding your own nonprofit, again, so if you have a nonprofit, there are processes to get exempt status from the IRS. So if you do get to that point where you already have an exempt status from the IRS, you can use it to fund that 501c3. Again, when you're applying to become to have the exempt status from the IRS, there is spelled out that your nonprofit must not be used for personal purposes. Your nonprofit, all of that is clear. So again, you can use it to fund the nonprofit, but again, it's clear that you're not using it to live your lifestyle. It's actually, for the public good. So yes, you can use it to fund that nonprofit, but again, the nonprofit cannot be to fund your lifestyle because that's not the purpose. But Fidelity definitely has donor advice funds for, so you could look into it. And some other brokerage accounts also have donor advice funds. Are there any other questions? All right, so the next one is W-2 plus a business. So please, I'm going to encourage everyone that we should think of starting a business. Businesses have a lot of opportunities for deductions. So even if you have a W-2, this is the year to start a business. As a business, you can deduct a lot more and you can use a lot more strategies that W-2 earners cannot. This is 2026. We have all the tools. We have artificial intelligence. We have obviously social media. We have, people around to support us. Whatever you like to do right now, whatever you enjoy doing, you can make it a business. This is a very important encouragement. Please, 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 let's start a business. The Internal Revenue Service is focused on profit making. So if you say that you have a business, you need to be making efforts to make profit. The moment you don't do that, it could be considered a hobby. And then you might be exposed to the hobby loss rule. So even though I'm encouraging you to think of something you like to be able to start a business, you also need to be actively pursuing profit. Again, actively pursuing profit. But I personally feel like it's doable because with your friends, with your family, with their friends and their family, that's already business, right? So if you like to travel, you could become a travel advisor, a travel consultant, a travel coach, anything you like to do. By the time you add advisor, coach, consultant, facilitator, that's a business. But you have to actively be pursuing profit. So you're a travel consultant. Do you have a website that shows that you're a travel consultant? Do you have customers? Do you have income? Again, that's a big one. Do you have income? Because I've seen a lot of businesses, no income the first year, loss, just losses. no income, just losses. First year, second year, third year, fourth year, fifth year. Then they're like, are you really doing business? Are you really trying to make profits? Or are you just using this for losses on your tax return? So again, it's possible that a business would have a loss, but you need to be actively pursuing profit. So whatever you decide to do as your business, remember, we need income. We need to pursue profit. Even if we have expenses that are more than those income, the fact that you can prove to the IRS that this is a business. I have clients, I have customers. I made $1,000, I made $300. Whatever you make, then it could be acceptable. But if it's just expenses and no income, no online, no, like we can't find your business, because trust me, in the event of an audit, they will research. They will research, they will find your business online, they will see your online activities, they would dig deeper. So please, 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 this is just a wake-up call. Like, start your business, but also with the goal of making profit. We need to see income. We need to see that you're actively doing this business, not just losses, losses, losses. Okay, I feel like I've done enough preaching on that one. But again, like I mentioned, once you have a business, and a business can really be a sole proprietorship. So that's another thing that is confused. People think that, oh, I have to go start an LLC. No, you do not. You can have a sole proprietorship. You could just start your business with your name, or, you know, whatever you're doing, you could just start the business. And then eventually, as the business continues to grow, then you can begin to, you know, go register the business as an LLC, and then have your business bank account, so we can separate the business activities from the personal activities. But you can start today. So you don't need an LLC to start a business. You can start tomorrow and you can start doing your business. But some of the things that are available for business owners, again, ordinary and necessary business expenses, right? So what the IRS requires is for it to be ordinary and necessary for the conduction of your business. So if you say that you have a travel consultancy business and your expenses have nothing to do with that, that is questionable. Ordinary and necessary for your business. All right. So that could include, you know, software, professional fees, insurance, marketing, education, even education. So for example, you have a cybersecurity consulting business and you're going to improve your education in cybersecurity. That is a business expense, because you can prove to the IRS that this is an ordinary and necessary business expense for my business. So let's maximize our ordinary and necessary business deduction. First of all, let's create business this year, and also, you know, maximize ordinary and necessary business deductions. Also, the business vehicle. So you have a vehicle that you use for business and you use for personal. You need to understand, what is the split? Am I 50% business on this vehicle, 50% personal? Or am I 100% business on this vehicle? You need to understand that. And then you could be able to deduct the expenses, either using the mileage or using the actual expenses. We also have the Section 179, which allows for bonus depreciation. So you buy a vehicle and you use it 100% for your business, you could take a Section 179 and you could bonus depreciate the vehicle 100%. So again, these are opportunities, but you have to have a business. You have to have a business where you're pursuing profit. Then retirement plan as well. So a lot of small business owners, I notice when I, you know, interact with them, that some of them don't pay attention to the retirement optimizations, the plans. So that is something you also want to think about. As a business owner, you can set up your solo 401k and you can begin to put money on it. This is deductible. So this is an adjustment on the 1040 to the Section 1. There's a Section 1 adjustment. So you could contribute to solo 401k. You could create a SEP IRA. And I guess the difference between the two is, with the SEP IRA, you have up until April 15 of the following year to fund it. So again, solo 401k, you need to have funded it by December 31st. But with the SEP IRA, you have up to April 15 to fund it. But as business owners, we also have to think of retirement, right? And again, I mean, maybe this might be more specific to people that are just doing business, because with W-2s, you have your 401k. But as business owners, let us begin to think of our retirement as well. Let's begin to put money aside for that. And then we also have depreciation strategies. So basically, if you buy equipment, laptop, technology, all of that, you can depreciate it. Then the next one is family employment strategy. So you have kids that can work in your business. You can employ them. So far you pay them less than 15,000, they don't have to pay the federal income taxes, right? But the caveat to this one is you need to make sure that they're actually working in the business, okay? So I've heard of people that they'll use their 2-year-olds and 3-year-olds and say they're modeling and all that. Again, it needs to make sense. Before you do anything, you have to think about, does it make sense? If I was the IRS agent and you told me that your 2-year-old works in your business, does it make sense? Okay. If it makes sense, then, you can be able to substantiate and explain. But that is another strategy, basically hiring your family, your children or spouse or family members. And then we have some tax credits that are also available, like research and development credits and, some other credits that could be used for businesses. All right. Are there any questions? I'm about to fly through because I know the time is fast spent, but are there any questions? All right. So the next layer is real estate. And I guess I'm a real estate investor myself, so I'm very passionate about this. But I do think that, we need to understand the different opportunities here and basically the limitations, because I feel like some way social media maybe has not really given people the clear picture of how real estate can actually help them with taxes. So this is something that I want to make sure everybody is clear. All right. So when you purchase a rental real estate property, you have to report that on a Schedule E. So Schedule E is for rental real estate. And basically, you have to report the rent and the expenses that you incurred. And out of those, we have depreciation, okay? So again, depreciation, a residential property can be depreciated over 27.5 years. So we start with the basis, the depreciable basis, and we divide by 27.5. So here, we have an amount that we can depreciate. So most times, by the time you include depreciation and you include all the expenses, you include your mortgage interest, your property taxes, marketing expenses, cleaning expenses, a lot of times that might be able to get you to maybe a loss on paper. Now they call it loss on paper. However, if your income is greater than the threshold, you might not be able to take advantage of some of these deductions. So I'm going to break this down again. Real estate is a great strategy. However, if your income exceeds certain thresholds, you might not be able to take advantage of the strategy. So I'm going to talk about the strategies and then talk about the caveat. So the first one is cost segregation bonus depreciation. So the next slide is going to show more on that. But this is a way to accelerate your depreciation where you can have a huge deduction in the first year. Now, this allows you to have a lot of losses from real estate that can reduce your taxable income. However, if you do exceed those income thresholds that I mentioned, you might have to look into qualifying as a real estate professional to be able to get that benefit. And when I say qualify, I just mean meet the Internal Revenue Service requirements to claim the rep status. So real estate professional, you have to have over 750 hours of real estate activity. So that is one of the requirements. And you also have to spend more than 50% of your time doing real estate activities, as you go around your daily activities, okay? So if you qualify for real estate professional, you're able to take advantage of all of these losses. So that is one way to do that. The second way to do that is if your income is less than the threshold. If your income is less than the threshold, you're able to get 25,000 of losses deducted based on active participation. So basically, are you actively participating? Even if you have a property manager, are you talking to them? Are you approving tenants? Are you making sure that they're doing what they're meant to? Are you actively participating? If you're doing that and your income is less than the 150,000 threshold, then you're able to take that 25,000 of losses. Then the third one is the short-term rental material participation strategy. So if you have a short-term rental, you have an Airbnb, and you rent it out for 7 days or less, and you're doing, you're actively participating, you can also take the losses that we discussed. So real estate provides a lot of opportunities, but you need to understand, where am I? Like, where is my income? Where is my AGI, my adjusted gross income? Which opportunity can I leverage? Can I take the 25,000, or do I have to be a real estate professional? And the typical understanding is that if you have a W-2, it's quite tough to prove that you're a real estate professional because of the requirements. But I personally would tell you that with the Internal Revenue Service, substantiation is the most important. Your ability to prove. So in this situation, if you have a W-2, but you have a remote job, you don't have to commute, you have time on your hands, you have the weekend, you have the evenings that you're doing real estate activity. You need to be able to log your hours. So for example, to show them that I did spend 750 hours doing real estate activities, you need to be able to document that. So I have an Excel file, I have a system that you use, and put all what you're doing. So on this day, I did this, I spent 2 hours. On that day, I did this, I spent 3 hours. Again, you need to be able to prove to them. Another strategy some people use is if the husband or wife, works and makes a lot of money, and then the other spouse would just be the real estate professional. But again, to really, really be able to get the benefit of real estate deductions, if you're considering like bonus depreciation and all these things, is if number one, you're able to claim somebody in your household, you or your spouse, able to claim a real estate professional, or you use the short-term rental material participation. The other options, there are limits to that. And again, this is to be able to use the losses from real estate to reduce your income. So we're basically taking the losses from real estate, we're reducing our income. You need to be able to pay attention to what you will qualify for. So if you're thinking of buying a rental property and you're thinking, oh, this will give me tax benefit, you need to take a step back and understand, how much do I make? Do I make 170,000? Oh, wow, I wouldn't be able to take this against my initial income. I can only match it to my rental income. So basically net zero, rental income, take everything to zero, but it doesn't reflect on my general adjusted gross income. So I'm going to pause. I know I just said a lot. So if there are any questions in the room, I'd like to clarify. Do we have real estate investors in the room? Okay, and you're clear.
Victor.
So I think you can still hear me. So I'll just explain again with the cost segregation study. So again, this is a situation where you have a rental property and you would like to take the bonus depreciation. The One Big Beautiful Bill allows for you to deduct 100 in the first year, 100% of the 5-year component, 7-year component, 15-year components. So that's when people need a cost segregation study to basically break down the components of a property into those buckets, which is 5 years, which is 7 years, which is 15 years, and which is 27.5 years. And the best way I explain this is with an egg. So if you think about a boiled egg, because this is a topic that people get confused a lot. If you think about a boiled egg, the different components of a boiled egg, we have the eggshell, we have the egg white, and we have the yolk. So that's the way I think about it. It makes sense in my mind. So if you take out the eggshell and you put it on the table, it's probably going to look the same, if you go for a long time and come back. But if you take out an egg white, that might begin to spoil faster than the eggshell. And then the yolk, I'm sure like after a couple of days, the yolk is already rotten. So think about a building like that. The different components of a building. We have the parts that they're going to last for long. Nothing is going to happen to them. We have the appliances that maybe in 3 years, 4 years, they're going to start breaking down. We have the pavement and the sidewalk that, maybe in 15 years, they're going to start breaking down. So cost segregation study basically identifies all of these groups and basically says, okay, for this property that is, the adjustable basis, the depreciable basis is 200,000. 30,000 of that is under the 5 years makers, which is modified, adjusted. Basically, it breaks down each of those criteria to, okay, 5 years, 7 years, 15 years, 27.5 years. And based on the one big beautiful bill for houses purchased in 2025, you can take that in the first year. You can take the 5 years, 7 years, and 15 years components all up in the first year. However, it's very important to know, if this is a property you're planning to sell, you will pay that back through the depreciation recapture. So that is something very important. This is a strategy that people use when they're holding the property long term. So we have some real estate investors every year, they buy 2 or 3 properties because they're using this strategy to reduce their taxable income. However, they know that this is for the long run. They're not planning to turn around and sell. Because if you turn around and sell, you have to pay those, all the benefits you got up front, you're going to have to pay back in taxes. So again, a cost segregation study is basically looking at the property and breaking down the segments, which is considered a 5 years, which is 7 years, which is 15 years. And then you're able to use those information to accelerate depreciation. But like I mentioned, it only is valuable if you're able to potentially qualify as a real estate professional, or maybe your spouse qualifies as a real estate professional, or if you're able to use the short-term loophole, like they call it. Basically, if you have a short-term rental and you have material participation, then you're able to get those losses. So I wouldn't want you to go buy some rental properties, hoping that you can get tax benefits, and then your income is also more than the threshold, and you're not able to get it. Because I did have a client like that where she was advised wrongly that she would get tax benefits, and then when all said and done, she wasn't able to do that. So please pay attention to what you can get. But real estate is a powerful tool to reduce your taxable income. Are there any questions? Okay. Yes, go ahead, sir.
My question is coming as someone who doesn't have a lot of experience in real estate or these things we're talking about. Does this have a deadline? If for any reason you have this, you've been investing or been participating actively, and you fail because you didn't know, so you have missed out, or is there a way to change that?
Okay, so if I got your question right, you're asking if there's a deadline for real estate participation?
For you to use this strategy,
Okay, gotcha. So the basic requirement is 750 hours of real estate activity during the calendar year. So from January 1st, 2026 to December 31st, 2026, you're expected to have 750 hours of real estate activity. What I advise my clients, it needs to make sense. For example, if you have one rental property, you need to be able to explain what you're doing, where you're spending 750 hours on one property, right? So again, you need to look at all the real estate activities you're doing and basically document it. So within that calendar year, you're expected to have a log of your activities. And the reason why we're keeping that is if the IRS ever comes back to ask you, you can provide your evidence of that. In terms of taking the benefit, when you're filing your tax returns, then there's a question on the Schedule E, which basically asks, if you're a real estate professional, or if your spouse is a real estate professional, then you just say the yes or no. So once you say the yes, it allows the losses from real estate to be able to reduce your W-2 income and all the other income that we already talked about earlier. So you have January 1st to December 31st to have these hours, but you also need to be able to defend them, right? So I advise some of my clients to, purchase properties. So I have multiple properties, right? Because again, what are you doing where you're spending 750 hours? You need to be, doing real estate activities, okay? So to answer your question, January 1st, December 31st, you need to log your hours. And then when you're filing your return, you basically elect to be a real estate professional. You don't have to take a real estate license or anything. You just have to be doing the real estate activities and be logging the hours the right way. Yes, sir.
Can you talk about some of the activities
Yes.
that would count?
Yes. So for example, like myself, I do have some rental properties. So for interviewing tenants, I'm always on the phone. I interview any tenants that I accept into my property. So interviewing tenants, doing walkthrough of the property. Sometimes now with all the virtual and digital tools, we can do virtual walkthroughs. So doing that. Also, any form of improvement to the property, right? And it doesn't have to be you doing the improvement. Just dealing with your contractor, walking through the house with your contractor, analyzing, like even your bookkeeping for the rental properties, like, oh, this is the rental income, these are the expenses. Those are examples of activities that you can do, right? Personally, I'm just giving you some of my own activities that I do. And again, the way I like to see this is 750 sounds like a lot, but I just think about it as 2 hours per day. If I do 2 hours per day on real estate, having that logged, and also, weekends as well, and, the evenings, like I have more than 750 hours, right? But yeah, those are just some examples. There's definitely more that, we could, just literally, if we go on Google, we'll find a long list. But personally, what is very relatable is just maintaining my property. I do an inspection every 3 months. I walk my properties. That counts. I discuss with my tenants. They reach out when there's problems in the property. I, communicate with all the contractors, with the insurance company, with the mortgage company. All of that counts towards real estate activities because those activities are required to maintain those rental properties. So yeah, so those are just a few examples of real estate activities.
So I have a question. In terms of documentation, is it as simple as just keeping a minute in your system, like a Word document or Excel file, or do you have to have something more sophisticated to show that, yes, this is what I do, I record them, or I should have, I just want to understand, when you say documentation, how sophisticated, how simple should it be?
Yes. So ideally, it would be good to have something where the timestamp it cannot be changed, sort of like evidence, right? So what I advise some clients is, have something that shows timestamp. Like, for example, even if you're logging it in an Excel file, have like some evidence, maybe like pictures with a timestamp. So basically, for example, if you had to go mow the lawn, just as an example, you had to go mow the lawn of one of your rental properties, maybe just take a picture before and after you mow the lawn and just try to make a timestamp there so the date is there, right? But you can't do that for all the activities. So Excel is a good one, but think about it. There's also one that somebody can put together when they're being audited, right? So again, let's try just to, try to, be truthful, but I do know that Excel is one that anybody can put together, right? But ideally, Excel is fine, but just have additional evidences that potentially have some timestamp so that it's, that's an additional evidence that this was done on this specific date. So yeah, Excel is fine. You could potentially use like some other tools. I know there's an AI platform out there that you can use. I'm also building one myself where it sort of picks the time, the exact time and date. And it's easy for people to log their hours. What I'm trying to build actually is a situation where it will be so easy, where you could just text the number and then it gets logged in. But that's like a future project. But anyways, what I'll say is you can use Excel, you can use any form of, Word, whatever you feel comfortable with, but have additional evidences that have timestamps, just a few additional substantiation that could show the timestamp and the date.
Is cost seg only for residential? Can it be used for commercial? And then also, how does IRS couple that with like opportunity zones?
Yeah, so with cost seg, you can do it for both residential and commercial. So it's not only residential. However, with commercial, we think about 39 years versus 27.5 years. So just make sure you're getting the right cost segregation study done with regards to commercial. But yes, you can do it for residential. You could do it for commercial as well. It's not only for residential. And then the next question was about opportunity zones.
Yes.
Yeah,
Like
so
how does that put them together?
Yeah, so I'm going to get to that. So I have a slide with opportunity zones, I believe. I'll talk about that when I get there. All right, are there any other questions? All right, so moving on. So now we're going to be talking about S corporation. Before we mentioned the value of having a business, we said you can always start today by having a sole proprietorship business. We said you can also try to make it an LLC by registering the business. And then at some point, when your business keeps growing, we need to consider an S corporation. And really, the primary advantage of electing as an S corporation is to reduce the self-employment taxes, right? So I'm just going to go through that a little bit quicker. So for example, this is just a simple example. If you were just having an LLC and you were making a profit of 100,000, with the self-employment, you could be paying as much as 14,000 in self-employment tax. But if you elect to be an S corp, then you're able to split the compensation to be a compensation and then distribution. But again, the caveat here is there has to be a reasonable compensation. So reasonable compensation, and then with that, you're able to basically split and have a compensation, and then you have a distribution. And basically that reduces the self-employment tax. So again, S corp is an election you make that helps to reduce the self-employment tax. But you have to know that with S corp comes more reporting requirements, right? So with an LLC, you're expected to do the right things, report the income, do all these things. But with S corp comes more reporting requirements. That's why it's advised that you have to make sure that your income, like the income you're making, actually makes sense to elect as an S corp. You don't just want to go and elect as an S corp, because then you're actually saying, is it worth it? Does it make sense, right? Again, S corp is an election you make to reduce your self-employment taxes, but you only make it when it makes sense for your income. So, different numbers are thrown around, but ideally, I try to advise my clients, if you're at the point of like $80,000 and above from your business and profit, you probably want to consider, S corp, right? Some people say 100, some people say less than 80. Again, it needs to make sense because there are extra reporting requirements and payroll expectations when you switch over to an S corp versus when you elect as an S corp versus just remaining as an LLC.
I have a question. When you said for people to elect or to choose to file as S corp, is that something they can do on their own, or they need to contact a CPA to do it for them, and then they need to apply to IRS? Just for people who may not know how to elect.
Okay, yeah, that's a good question. So there's actually a requirement. So basically, when you're electing for S corp, you need to elect by March 15th. So for example, for 2026, if you want to elect as an S corp by March 15, that's the requirement for the year. And then what you need to do is to complete a form 2553, which is basically electing as a small business corporation. Again, this is something that you could potentially do by yourself, or mostly recommended is to find a CPA that can assist you with doing that. But again, what you need to do is to file a form 2553 to be able to elect as an S corp, and the deadline is very strict, which is March 15th of the year that you're trying to elect as an S corp. So yeah. Okay, and then for S corp, there are a lot of strategies as well. But again, the first one is the reasonable compensation. It has to be reasonable. Some people, they would put very little compensation. Again, that's one that the IRS can pick up if you put like $10,000. Is that a reasonable compensation? So that is one that the IRS would scrutinize if it's a reasonable compensation or not. But that is one of the expectations, that reasonable compensation. Then also there's the accountable plan strategy that S corps can use. And basically, this is a strategy that some of my clients use with their home office deduction. So, for example, they do a lot of their business work in their home. What they do is they're able to refund themselves from the business of those the portion of their home that they use for business. They're able to refund it from the business account. So again, an accountable plan basically allows for business expenses to be reimbursed from the business. So that's another strategy. And then the retirement optimization, like we mentioned, the different options, the solo 401k, the SEP IRA, those are retirement plans that are also open to S corps as well. And then, the depreciation strategy, basically similar things to what we talked about, LLC, but a big one for S corp again is that they're reducing that self-employment tax. And the Augusta rule, which I'm going to talk about in the next couple of slides. All right, and then C corp. I feel like as a C corp, definitely you need a CPA. So, so yeah, I'm just highlighting, C corp. Basically, for it's common, there's double taxation in that situation, right? But it's more so for big businesses that want to raise outside capital. They want to, these are businesses that are interested in mergers and acquisition, like bigger businesses. Ideally, I don't advise small businesses to consider a C corp. But again, if you do have a C corp, I believe that you should definitely have a CPA that you're talking to and planning with. All right, so these next slide is focused on strategies that a lot of people don't use, and that is available, to be used, right? So one of them is actually one that, I love. It's the Augusta rule. So I don't know if you've heard about it, but basically what this allows you to is to rent your home to your business for up to 14 days at a market rate. So for example, as a business owner, if I need to do a meeting with my board of directors or if my potential clients, or if I need to basically do like a campaign, or if I'm packaging some materials and I'm trying to do some marketing distribution and everybody's gathering at my home and we're all putting everything together, you are able to deduct up to 14 days, as a business expense. So basically, the business will pay you for the 14 days for the use of your home. So that's a very important one that we should definitely be taking advantage of. And for something like that, to document it, I would just ideally have a picture or just something that would evidence it, that there's actually the client meeting going on. And we're not just taking this 14 days at the rental rate, but there's actually something for the business that is going on. Then the other one is hiring your children. So that's also something very important. And once you have a business, we should definitely look into hiring our children. So far, we can prove that they are able to do the activities that is mentioned, right? So for example, you would ideally want to have some form of work agreement or some form of employment agreement, basically stating what the roles and responsibilities. And even a step further is even logging their hours, or just some way to track what they're doing. There has to be some form of back and forth communication, email communication, showing the work they're doing, because we don't want to just hire our children and take those expenses and then there's nothing, right? So again, this is a strategy, but we have to make sure we're able to substantiate in the event of an audit. Then the next one is defined benefit. Sorry, go ahead.
Sorry, I have a question. So
Yes.
is there an limit to you hiring your children? For instance, if your children are maybe minor, they're like 5, they're like 6, and you're trying to hire them, is there an age limit?
No, there's no age limit. However, it needs to be reasonable, right? So for example, for a 5-year-old, you need to be able to state what exactly are they doing? How much are you paying them per hour? Like all of those need to be established. So, if you can find ways that your 5-year-old can contribute to your business. I have some clients that, for example, one of my clients, she owns a restaurant, and her daughter is able to, pick up some plates and, move the food, or anytime there's catering going on, the daughter is able to wash some dishes. Again, you have to be able to explain, and it has to be reasonable, right? So yes, you can hire a 5-year-old or 6-year-old, but you need to be able to, whatever they're doing needs to make sense, and they need to have basically, what are you paying them per hour? It needs to sort of justify the value they're bringing. So you cannot say, oh, I'm paying this person $100 per hour. That's a red flag. But if you make it reasonable and say, oh, they get paid $4 an hour and they're doing XYZ, that is totally fine.
So does every CPA know about this? And I'm asking because, like, we hire our daughter, she models our hair care products.
Mm-hmm.
And there was one time we were speaking with a CPA when we wanted to file, and we explained that she models the products, we post her pictures with the products and stuff, and she didn't understand like hiring your child. So that's why I was asking, is this something that every CPA knows, or if your CPA doesn't know, find another CPA?
Absolutely. Absolutely. I mean, see, we focus on like planning and strategy and making sure that you're reducing your taxable income, right? Some CPAs focus on filing. They just want to file and just get you through that deadline, right? So please, 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 if your CPA is not talking about all these strategies, you need to find someone else that will offer you all these strategies. Sorry, go ahead.
Fire your CPA, hire another CPA, right?
Yes, absolutely, absolutely. I have clients that come to me, and their CPA. Obviously, I review whatever has been done prior, and I'm just shocked. Again, not to talk bad about another CPA, but basically, if your CPA is not providing strategies for you to optimize, definitely look for another CPA. Please do. But yes, not everybody talks about all these strategies, but these are strategies you need to start implementing this year, so that in March or February, or whenever next year you're filing, you can actually see the true impact and the true value.
With the Augusta rule, is that, I know that doesn't apply to rental property, but can you, like secondary property, beach property, mountain property, could that be used as well? And then how would you document that to the IRS? What is the requirement for documenting?
Yeah, so to my understanding, the Augusta rule would be your personal residence, basically renting your personal residence to your business. So that's why you're paying yourself rent for that. I could see the argument for secondary residence, but the ones I've seen, like that I would totally approve of, is just your personal residence. But I can follow up with you, like in terms of the way to document if it is allowed to use a secondary home, but your personal residence is what I typically advise my clients to do. Because again, like with the secondary residence, some people, even though like it's secondary and they're claiming to only stay there in certain times, some people also use that for other things where family and friends can stay there, and there's just, it could get a little bit confusing in that regard. But for your personal residence, you can rent it to your business, and you could deduct it as a business expense. Are there any other questions? Okay. So the next one, which is one that I personally love to talk about, is foreign contract labor. So I personally, I have family and friends in Nigeria, and, given the economy and, all of that going on over there, so people need funds, right? They need money. They need to be supported. However, I made a rule this year that I'm only going to hire people to work for me. Okay. So they would work for my business, and they would be paid. So I don't know if you have people that depend on you. This is a strategy where you can sort of switch it to be, you can work for my company, and I can pay you, and it will be a deductible business expense. because it's going to be recorded as a foreign contract labor expense versus just, distributing. And again, it's okay to, help and support people. But for me personally and, my clients, this is an advice I provide, which is if you have, some people that depend on you, they can work for your business. What you need is for them to fill out the W8BEN, which is basically showing that they're not U.S. persons, they're, international persons and they're foreigners. And, you also need a form of agreement between you and them. Basically, just like hiring your children, showing what exactly they're doing for you and their rates. So whatever you're going to be paying them. However, again, substantiation, right? So if you say that they're doing research for your business, we need to see that communication between you and them. We need to see some reports they're building. We need to see evidence of that, okay? So this is a strategy that exists, but again, we have to be careful because they should actually be doing the business. I mean, they should actually be doing the work for your business. So this is one that I think a lot of people don't know about. You can hire foreign labor to work for your business, and you can pay them deductible to your business. Again, this specifically for some people that currently send a lot of money to diaspora anyways, a good way could be just to, instead of just sending that money, it could be a way to make people employable and have them actually work for your business. Are there any questions on that one?
Many questions. First of all, you need to tell me this whole time we could actually claim all this money you send into Nigeria if the person is working for you. Okay, I'm fine.
Absolutely.
I'm buying our CPA. No, but our CPA, so you go, so there's no way you would. Our CPA is American. They don't know anything about it. Okay, what form do we need to fill to?
Yeah, so it's a W8BEN. So literally, if you Google W8BEN, it basically is a document showing they have to identify their names and everything. Also, they need to actually be doing the work. So that's the tricky, you have to make sure that there is an agreement. So currently, I have a lot of employees in Nigeria, social media team, all of those. Those are people that maybe I would have even given money normally, but instead they're working for the business. But again, there has to be evidence, emails back and forth, reports given. They need to show what they're actually doing. But yes, that's something that I feel like a lot of us don't even know about or even taking advantage of at all.
No, I just wanted to say it's W8BEN.
BEN, yes, W8BEN. So it's basically synonymous to the W9 that you would have filed if you're using a local contractor, like an American contractor. But in this situation, it's like a foreign contractor. So it's W8BEN.
Sorry, in that case, do you pay tax on their behalf, or you just pay them and they don't pay tax?
Yeah, so you pay them and then it's deductible to your business. So based on the country they're in, they might have some requirements they're meant to be doing. But for you and your business, you pay them and you can deduct it as a business expense. Now, based on the country they're in, they might have laws saying any income needs to be taxed. It depends at that point to the country that they're located in. But for you personally, you can deduct it as a business expense and, they can get paid.
If you didn't use that before, can you go back and
Claim
do
all
an
the
adjustment?
years. Claim all the years.
Yeah, I mean, that one will be tricky because then you probably have to do an amended tax return. And, I personally would just, moving forward, just making sure you have everything, all the example, W8BEN that is dated and signed. And, you have all the records of the agreement. What exactly are they doing for your business? What is the compensation? And just having all of that, guaranteed. Because, if you go back now, there are chances that you might not pass an audit if the IRS comes back and asks you, to prove all of those things. So I'll just say, just going forward, let it go. You learned, now it's time to fix things. But yeah, that's what I would advise.
So while we're on that, what about like when you do like charity work outside of the US?
So that is trust me, I've heard that one a lot of times. All my clients are like, I send all this money to all this, religious organizations, and but the requirements is a 501c3 in the United States, right? So with regards to that one specifically, that is the expectation, a 501c3 organization in the US.
And then once you have a 501c3 here, you can now record those expenses and deduct them.
So is the question that you have a 501c3 in the US, but you're doing projects all around the world?
Mm-hmm.
Okay.
Yes.
Okay. So in that regard, the contribution is going to the 501c3 in the US, so it's deductible. Now, if your organization is doing work all around the world, and that's what your organization is doing, that's what your organization is doing. I mean, we have so many organizations that's what they do. They go to Africa, they go to different continents, and they actually do projects. So if that's what your organization is doing, that's fine. But the contribution, the donation, for it to be deductible, it needs to be going to a 501c3 registered in the United States.
Okay. Thank you.
Question. Foreign contract labor, the expense that you incur by way of payroll to them, that's only chargeable to US income, right?
So this would be if you have a business. So you have a business and then you hire somebody to work for you. So basically you're paying them salary and is an expense to your business.
Right, so I don't have to justify, even though I'm not making any income from them. All I need to show is that I'm paying them for this as payroll expense, which I can charge against my US income, right?
You can charge against your business, right? But again, remember what I mentioned, that with the IRS, business has to be for profit. So, you want to make sure that you're trying to do business for profit. If for the first year, which is typical, first year, sometimes no profit, you can still incur this expense. So far, they're actually doing work for you. So I've had clients where they have a team in Ghana that is researching, the landscape, the business they want to get into, the business they're doing a lot of research. For the first year in that situation, they're incurring this expense, and they don't necessarily have income, right? So yes, it is an expense for your business. However, again, the IRS needs to see that you're actively trying to make profit. When we get to the third year, you cannot sell the same story that they're researching and there's no profit, right? So again, this is an expense to the business. And remember, the goal is to actively try to make profit.
I have a. Okay.
Is there any strategy around having your own 501c3 and hiring the foreign worker for that versus hiring them for just a typical S corp or LLC? Is there
Yeah.
any benefit?
So if you have a 501c3 as well, you can hire foreign labor. You can also hire domestic labor. They don't you're open. You can hire whoever you want to hire. Just need to make sure you're doing the right things, W8BN for anybody you're hiring, and documenting everything. But yes, even if it's a 501c3, you can still hire people from anywhere.
I wanted to ask real quick. This would be like for later, not necessarily for the supporting here, but for if you're like content creator, for example, you're allowed to claim, like if you make videos in your car a lot, for example, could you? And I think I know the answer, but I still you can claim your car as a company expense. Let's say you're shooting a lot of videos in your car. Are you able to, if you're shooting a lot of videos in your house, what can you claim, what can you not claim? Your cell phone, can it be company expense? You need to feel, why are you laughing? Your travels as well, let's say like you travel a lot for like speaking engagements and stuff like that. Like, so how far can you go? How much can you push?
Yeah,
What
so
can you claim?
that's a very good question. So everything goes back to the IRC the Internal Revenue Service expectation that it is ordinary and necessary for your business. So if you have a cell phone and you use it 50% for business, you can claim 50% of the expenses for your business, towards your business as a business expense, right? If you have a vehicle that you use for business 100%, you can claim 100% for business. However, if you use it as well for personal, you need to be able to identify what percentage do I use, what amount of time do I use for personal versus business. So for things that you're using for both, it's on you to tell the IRS, I use this 50% for personal use and 50% for business use. And in that situation, the cost will be divided by two. 50% can be claimed under your business, and the other 50% would just be a personal expense. So again, when you travel, is this travel ordinary and necessary for your business? If the answer is yes, did this travel involve any form of personal, uh, you know, situation, right? And I think it's just being reasonable, right? So, for example, if you're going on a family vacation and you don't do anything about your business, now that's putting yourself in a tricky situation because you cannot prove to the IRS. But if you strategically position your business in anything you're doing, so you travel, but you're actually marketing your business. You're telling people about your business. You're meeting with clients at the location of travel. Those are ways you can substantiate to the IRS that this trip to Miami was actually ordinary and necessary for my business. I met with client A. We had a meeting. We have our minutes from our meeting. I went to this location to share flyers about my business. I spoke to 20 people about the purpose of utilizing me as their CPA. If you're able to substantiate, then yes, you can defend that it's ordinary and necessary for the business. So again, whatever you're deducting, you need to make sure that there's business use, because I guess one that is interesting is travel. There are very interesting situations of even wealthy people utilizing like private jets for like trips and trying to claim those as business expense. Now the question is, was it really a business expense? Who were the people on the private jet? All those questions will be asked if someone is audited. So again, just try to make sure that it is an ordinary and necessary business expense.
Thank you.
Are there any other questions? Okay. Oh, yeah, we're way past. Okay. All right. And then finally, I just, the IRA types, right? So we talked about a lot of IRAs and, retirement contributions. So just wanting to make sure that everyone understands the different types, and they have different requirements, but just making sure that whichever type that you want to do, especially as small businesses, it's very important for you to actually start something, maybe like a solo 401k or a SEP IRA, and just put some money in there, right? Again, it's a way to think of retirement and to gradually put money towards retirement. But this just explains the different types. At the end of the day, these things are retirement accounts. The goal is some of them are deductible now, some are deductible later, but the goal is to save towards retirement. Again, business owners, please try to leverage these, start to put money there, and be consistent with that. And again, like I personally, I use my 401k. I like to use myself as an example, but I use my 401k. Sorry, I use my 401k, I max it out, and then I borrow on it. So that's a strategy I personally use. I max out my 401k, and then I take a loan on my 401k, and I use that for other projects. So that's another strategy we could talk about another time, but again, these are ways to save towards retirement, and then you can use it later. You could get the money later. All right, so I know sorry, go ahead.
Go ahead, sir.
No, it's just on the last one you talked about. I don't know whether you want to talk about it now. I know you said you could talk about data, but I would really love to take a learning from that in terms of I can max my retirement account and then borrow from it. Could you explain that further, please?
Yes. So absolutely. So again, what I do personally, I max out my 401k. Remember, the limit is 24,500 for the traditional 401k pre-tax with an employer. So I max that out every year. And then I borrow on it and I use the money to invest in real estate or any other project. So basically, what happens is you're using your 401k as a collateral for the loan. And then, ideally, you could pay it back in like months and even multiple years. But you need to figure out the whatever your company uses for 401k. And there's an option to take a loan on your 401k, and you can take a loan on the 401k. You get the money and you can use it for something. So instead of going to the bank, I am my bank. So I fund it every year, put the 24,500 every year, and then when I need money for a project, I borrow from myself. But again, the expectation is it's a loan, so you need to pay it back, and you basically have to treat it very seriously, because if you don't pay it back, then you might expose yourself to penalties and early withdrawal penalties and taxes and things like that. But yes, it is a way that you can borrow on your 401k. In that situation, you are the lender. You're the one borrowing yourself the money.
Okay, and it's not restricted even though it's a W-2.
No. So you're borrowing on the 401k. And then again, this is with the assumption that you've been contributing, right? So you've been contributing, let's say you've contributed for 5 years and you have like $100,000 in your 401k, you could take a loan on your 401k. Now there's a cap. It depends on the brokerage company. Some allow for 70%, some allow for 50%, some allow for 30%. It depends, right? You need to figure out what yours allows for, and whatever you want to use this loan for, because there's an interest. But personally, I found the interest to not be as much as the banks. And also, I would just rather borrow from myself. I mean, it's my retirement account. But again, just holding yourself accountable that this is a loan. I need to pay back. If I don't pay back, I might expose myself to the penalties. But yes, you can borrow on your 401k.
Thank you.
Sure. So, are there any other questions? Okay, so even if you have questions, I actually would like to, all the people in the room, I'd like to offer a free tax planning session with everyone. There's not a lot of people in the room, so I could do that. So, I'll share my information with Adiola and everyone in the room. We can have a one-on-one session where I go through, your tax returns, and we come up with strategies together that you can implement. So thank you so much. This was actually really fun. Thanks for the participation. And I look forward to speaking to everyone in the room. So I cannot hear anything being said on the.
Can you hear us now?
Yes, I can hear you now. Yes.
Okay. Please share your, what's it called? Please share your contact information with everyone for those who may be watching online that would not see what we are trying to share.
Also, are you licensed across the US in all 50 states?
So I'm licensed in Texas. So it's a state license. A CPA is by state. I'm actually currently licensed in Alaska and Texas, but ideally you should be licensed in one state. But I can practice all around the country. So there's no requirement to be licensed in a specific state to practice in a specific state. No, as CPAs, we can practice all around the country, but I'm licensed in Texas. And my website, sorry, go ahead.
What's your email address?
Yes, my email address is, you can reach me info, so info at trustbar.com. You can also reach me by olu at trustbar.com. And my website is just www.trustbar.com. Yeah, so again, reach out. My phone number is 504-435-9115. Yeah, we're here to serve. Reply.
So, I'm writing all this down. My side are very fast. 504
435 9115.
504
435 9115.
And I have trust info@trustbar.com.
Yes.
What's the other email address?
So it's my first OLU at trustbar, TRUSTBER.com.
Is that BER, BAR?
BER.
Okay.
All right, can everybody see? Oh, there's no space between her. Like that again. Sorry, there should be a space between the number and the last email.
Do we need to mention anything when we contact you that we're in the class, or?
Yeah, you could just put, like, if you send an email, just put Diaspora Success Network and.
Or you came from Victor, so she doesn't charge you. So she's trying to do things only for the people in here. So she needs
Yes,
to know
only
you.
the people yes, only the people in the room right now. All right, thank you so much. Again, I'm passionate about this, and I really hope that a lot of people would take advantage of these strategies. Again, taxes are expenses. Just the way we try to reduce every other expenses in our life, we need to try to reduce our tax burden as well. Again, a lot of the wealthy people and organizations, they have lower tax rates than some of us, effective tax rates. So please, let's try to plan. Again, we still have time for 2026. This might be the time to start opening some of those retirement accounts. This might be the time to start engaging foreign contract labor versus just sending money. This might be the time to do some other strategies that we discussed. But please, let's take that a little bit more seriously. Thank you so much.
Thank you. Thank you so much. Bye.
Thank you.
You guys enjoyed that?
Yes. Thank you so much.
Robin,
Thank you so much, everyone, for coming. We really appreciate having you here. And we have a guest sign-in sheet. If you don't mind, just giving us your name, phone number, email address.
That was very informative, by the way.
I know. So we have this meetings once in a month. And we meet here. The next session will be about how to get grants from the government or government contracting basically. So she was supposed to come today, but she has another event in America. So she's coming next month. I'm yet to get the time. I'm yet to book this room. So, but once I have the date and time, I will definitely send it to you via email and the group chat. What's up?
Thank you.
Thank you so much.
Thank you, Mr. Victor.
Thank you for coming. Say thank God she didn't come today because you have been too many information at once.
Although it would still be one topic.
I know, right?
Just
Yeah.
one.
That is these two at the same
I
time.
think we've seen you.
Who?
And that's
I've been on the screen since.
Oh, okay. All right. Thank you, everyone.
Thank you
so much.
Yes. I this is a new face, so I'm like,
Mr.
Yes, I am.
I got a message from Mr. Sude. Yeah, he said to.
Yes, I'm
Thank you so much.
by the way, everybody, nobody brought their wife, girlfriend today. I'm the only woman in the house. All right, so. Papa, we need our mother, so.
Are you based outside of here?
Yeah, I just moved here.
Oh, okay.